Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Hycroft mining.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And real quick, before we get into the actual mechanics of Hycroft today, I want to mention a really useful chart tool for those of you trying to navigate these massive momentum shifts.
Right, because reading the tape on something like this can be, well, it can be pretty chaotic.
Exactly. So if you want help reading trading charts more clearly, you can check out VIP Algos. The link is below in the description.
Yeah, VIP Algos is a TradingView indicator suite. It basically gives you visual buy and sell chart alerts.
Right, and it has trend direction tools, support and resistance zones, and take profit and stop loss planning areas, which is super helpful.
And you can use it across a bunch of markets, stocks, Forex, crypto, indices, futures.
Yeah, exactly. But we do need to be clear, VIP Algos is an educational chart analysis tool only.
Right. It is not financial advice.
Exactly. It doesn't place trades for you, and it absolutely does not guarantee profits. Trading always involves risk.
So always manage your risk and, do your own research. And just a heads up, that's an affiliate link in the description, so we might earn a commission if you use it at no extra cost to you.
Okay, so let's unpack this wild situation with Hycroft mining.
Yeah, I mean, the narrative tension here is just absolutely insane to me.
It really is.
We are looking at a total shareholder return exceeding 950% in 2025.
Right.
I mean, the stock is up almost 10x over the past year, and it's already up over 35% year-to-date in 2026.
Which is a massive re-rating.
But from a practical, risk-aware standpoint,
Yeah.
those numbers naturally make a cautious investor raise an eyebrow.
Oh, absolutely.
Because essentially, why should you, as a long-term wealth builder, care about a company that intentionally shut down its own operations and makes absolutely zero money right now?
Well, look, if you are looking for a reliable dividend payer, right, or like a mature, steady-state producer, this is just not the play for you.
Right, look elsewhere.
Yeah, but within a broader wealth strategy, this represents a really unique blend. It's a high-growth, turnaround, and speculative play all rolled into one.
Okay, so what's the actual hook for long-term investors then?
It's the leverage. They are looking at this because it offers incredible leverage to commodity prices, specifically gold and silver.
But don't producing gold miners offer that same leverage?
Well, no, because when you buy a traditional already producing miner, that leverage is largely priced in. The market already knows what they pull out of the ground every quarter.
Ah, I see.
Yeah, with a developer undergoing a massive transformation like this, that leverage is completely unpriced.
Meaning the upside potential is significantly more violent when they get it right.
Exactly.
But shutting down operations, I mean, usually that signals a distressed asset, right?
That's the normal assumption.
Yeah, it usually means the business model failed and they are waving the white flag.
And that assumption is exactly what management had to fight against here. Because the zero revenue state right now, it isn't a failure of the asset itself.
Okay, so what is it?
It's a strategic pause for a massive operational pivot. See, they were running a very specific type of mining called oxide heap leaching.
Which, if I understand correctly, is essentially taking crushed rock, piling it up, and sprinkling chemicals over it to pull the gold out.
Yeah, that's the basic mechanism. It's much cheaper to run.
Right.
But it only works on very specific oxidized surface ore. And at their previous scale, running that process was just bleeding cash. The cost simply exceeded the metal prices.
So they were losing money on every ounce.
Exactly. But the bulk of the gold and silver they actually have in the ground is trapped in complex sulfide rock.
And I'm guessing you can't just sprinkle chemicals on sulfide rock.
Nope. You have to physically grind it down to a fine powder and chemically separate it in a highly specialized facility that's called sulfide milling.
Oh, well. Okay, so instead of continuing to dig themselves into a financial hole just to show, revenue on a spreadsheet, management actually showed extreme capital discipline.
Yes. They stopped the subscale operation to preserve their resources for this sulfide milling approach.
Which is far more expensive to build up front, I assume.
It is, but it recovers drastically more metal in the long run. They recognize that continuing the old way was just destroying shareholder value.
So pausing operations basically protected the asset while they figured out the engineering to unlock that complex rock.
Exactly.
Okay, that structural shift actually makes sense of the pause. But I mean, if they stopped mining to figure out a better way, we need to know exactly what that better way is actually worth.
Right, which brings us to the fundamentals.
Yeah, the SK 1300 Technical Report Summary. And just to clarify for everyone listening, And SK1300, it's not just a marketing brochure.
Oh, no, not at all.
It is a highly rigorous SEC-mandated reporting standard. These are legally binding, heavily audited engineering and geological facts.
Yeah, you can't fake these numbers. And the sheer scale of the numbers in this report is what's driving this entire market narrative.
So walk us through the scale.
It's almost hard to wrap your head around. The SK1300 outlines a 51-year mine plan.
Wait, 51 years.
Half a century of continuous production.
That is insane. I mean, just to put that into perspective for you, most mining projects are thrilled to map out a 10 or 15-year life.
Exactly.
A 51-year life makes this a multi-generational asset. It means the company isn't facing a reserve cliff where they suddenly just run out of metal in a decade.
And it gets better because the production is completely front-loaded.
Oh, really?
Yeah, the first 10 years alone are projected to average more than 330,000 gold equivalent ounces annually.
Wow.
So we aren't just talking about a long life, we're talking about massive Tier 1 volume from day one of commercial production.
Which confirms a highly robust, long-dated revenue generation capacity.
Excellent.
You know, what stands out to me from a risk mitigation standpoint is the infrastructure. Because permitting and pouring concrete in this industry usually takes a decade.
At least a decade.
But they already have over $1 billion of existing brownfield infrastructure in the ground and roads on the map in Nevada.
Right.
It's like having a massive, fully permitted factory where you only need to change the assembly line machinery inside. You aren't building a brand new factory in the untouched wilderness.
That is a perfect analogy. That billion-dollar head start drastically lowers the execution risk compared to a greenfield development built from scratch.
Right.
It creates this massive competitive moat. And geographically, being in Nevada is crucial.
Because it's a Tier 1 mining jurisdiction.
Exactly. It's safe, the rule of law is strong, and mining is just culturally embedded there, which matters immensely when you are planning a half-century operation.
Yeah, you need the local government on your side for 50 years.
Yep.
But strapping out those conveyor belts, shifting to this new sulfide milling process, that requires an immense amount of capital.
It really does.
So what does their financial health actually look like while they're sitting here at zero revenue?
Well, this is where this story diverges from almost every other developer out there.
How so?
Normally, zero revenue developers are just drowning in high-interest debt. They're constantly issuing new shares just to keep the lights on and pay their executives.
Right, the classic junior mining death spiral.
Exactly. But Hycroft possesses a uniquely fortified balance sheet. As of March 31st, 2026, they held $189 million in unrestricted cash.
And what about their debt?
Zero debt.
Wow. Zero debt is incredibly rare in this space.
Unheard of, almost.
I know they executed highly successful oversubscribed equity offerings in 2025, right?
Yeah.
Raising something like $235 million.
Yes. And they used that to completely wipe out their debt and significantly strengthen their shareholder registry.
So because of that aggressive restructuring, they now have, what, like 6 years of financial runway at their current spending levels?
Roughly 6 years, yeah. They bought themselves the most valuable asset in the mining sector.
Which is huge. But having 6 years of cash is incredible armor, sure. But survival isn't the same as growth.
That's true.
The market isn't going to just sit around for 6 years waiting for a hole in the ground. What actually forces the market to reprice this asset in the near term?
Right. Let's talk catalysts.
Yeah, let's look at the timeline starting with June 29, 2026.
So June 29th is a massive structural catalyst. That is the date of their official inclusion into the Russell 3000 index.
Okay, wait, so let me make sure I have the mechanics of this right for everyone.
Sure.
Even if a passive fund manager hates gold or literally doesn't even know what Hycroft does, the second Hycroft is added to the Russell 3000.
That fund's trading computers are structurally forced to buy the stock just to match the index weighting.
Exactly. That is wild.
It's the exact mechanism at play here. There are hundreds of billions of dollars sitting in passive index funds and ETFs that track the Russell 3000.
Right.
And those funds do not care about the SK1300 report. They don't analyze the gold price. Their only mandate is to perfectly replicate the index.
So on or around June 29th, when Hycroft is officially added, all of those passive funds are forced to buy the stock.
Yes. It creates a structural demand shock. They have to buy, regardless of price, to balance their portfolios.
Wow, okay, so it forces a wave of indiscriminate mandated buying.
Exactly.
But wait, wouldn't you say this passive index inclusion is probably already priced in, considering the massive one-year run-up?
To some extent, yes. The smart money anticipates the inclusion, but the sheer volume of passive buying still creates significant liquidity and price support. And it's not the only catalyst.
Right. What else is on the horizon?
We have the Q2 2026 Sulfide Milling Preliminary Economic Assessment, or PEA.
Okay, so how does that differ from the big report we just talked about?
The massive SK 1300 gave us the big picture numbers, but this PEA provides the detailed engineering and financial roadmap. It takes the project from an initial assessment closer to a fully bankable study.
Got it. And there's also an exploration angle here that feels like a massive wildcard, doesn't it?
Oh, absolutely.
Because over the next quarter, they are expanding their drill program from 2 to 4 core drill rigs, targeting the Brimstone and Vortex systems.
Right, and those are high-grade silver systems.
And here is where it gets really interesting for you listening.
Yeah.
These systems are completely excluded from the current $10 billion valuation model.
Yes. Less than 15% of their massive 64,000-acre land package has actually been incorporated into the current resource model.
So any positive assay results coming from Brimstone and Vortex act as continuous positive news flow.
Exactly. And it's pure upside. It adds to the underlying valuation without cannibalizing the existing model in any way.
So with all these impending catalysts, it makes total sense why the stock price is behaving the way it is on the charts.
Yeah, the technicals tell a very clear story here.
Right. I mean, the technical structure we are seeing is one of strong breakout momentum. A 950% return in 2025 isn't just a random vol pump and dump.
Not at all. The stock has established a clear series of higher highs and higher lows. The chart is reflecting a company moving from a speculative microcap to a recognized institutional developer.
But even with that structural transition on the chart, there is a pretty significant valuation gap, right?
A huge one. Despite the 10x rally, the stock is currently trading at roughly $2 per ounce of silver equivalent in the ground.
And what's the average?
Well, if you look at the peer median for silver developers, it sits around $3 per ounce.
Okay.
So, strictly on a comparative basis, it is still trading at a massive discount. The price action we're seeing is simply the market attempting to close that gap.
And honestly, finding those newly established support and resistance levels after a 10x run is exactly why clean chart workflows are so necessary.
Totally. You have to be able to see through the noise when an asset is re-rating this aggressively.
Right. So the chart gives us the price structure. But to understand the fuel behind that chart, we have to look at market sentiment.
Right, what's the mood?
Exactly. What does market sentiment look like right now?
The mood is overwhelmingly bullish. And it is entirely anchored by that new SK 1300 report.
Because the numbers are just so huge.
Exactly. I mean, when a company officially publishes a binding document showing a $4.3 billion post-tax net present value in their base case,
Yeah.
and a staggering $10.0 billion NPV at spot prices, the market has no choice but to pay attention.
Especially when the internal rate of return, the IRR, is 30.1% at spot prices.
Right.
Because for a mining project of this scale, requiring billions in heavy machinery and earth moving, a 30% IRR is incredibly lucrative.
It's phenomenal, and that math has completely transformed the shareholder base.
Right, from retail to institutional.
Exactly. Through those 2025 equity offerings we discussed earlier, they strengthened the registry to the point where over 80% of the shareholder base is now institutional.
Wow, so it's no longer just a retail meme stock?
Not at all. Smart money has moved in and taken a seat at the table. And we are also seeing leadership shifts that suggest they are gearing up for the big leagues.
Like the CEO transition.
Yes, CEO Diane R. Garrett recently transitioned to executive chairman. That is usually a very deliberate move designed to align the board and management for long-term strategic execution.
It definitely signals stability.
Yeah.
And frankly, with a 51-year life, zero debt, and a Tier 1 jurisdiction, it's fueling a lot of credible industry speculation right now.
Oh, the rumor mill is spinning fast.
Yeah, the major rumor is that Hycroft has made itself a prime M&A target.
Which makes sense.
Right, because if you were a senior gold or silver producer, your biggest existential threat is replacing the ounces you mine every year. You constantly need to replenish your reserves.
And a fully permitted multi-decade asset in Nevada with no debt is the ultimate prize to solve that problem.
Exactly.
Plus, there is also ongoing chatter about metallurgical testing that could yield a highly lucrative sulfuric acid byproduct stream.
Really?
Yeah, it's unconfirmed, but it adds another whole layer of potential revenue to the bullish sentiment.
Okay, so that sentiment picture is incredibly strong.
Yeah.
But we still need to talk about the risks.
Oh.
Because a $10 billion NPV looks amazing on paper, But building a mine of this scale is never a guaranteed victory.
Far from it. Let's address the $2.4 billion elephant in the room.
Yes, the initial capital expenditure.
Right. The capex required to get this sulfide milling operation up and running is estimated at $2.4 billion.
And I look at this analytically, right? You have a company with zero revenue and $189 million in cash.
Yeah.
But they need $2.4 billion. How on earth do they get that money? How do they bridge that gap without absolutely crushing current shareholders with equity dilution or signing project financing terms that are just incredibly punishing?
It is undeniably the single biggest risk to the entire thesis. If they try to raise $2.4 billion purely through issuing new stock, the dilution would be absolutely devastating to the share price.
Okay, so how do they avoid that?
Well, here is the aha moment for me. This is why that $189 million in the bank is so critical. It isn't just survival money to keep the lights on, it is leverage. This is the ultimate high-stakes chess match. Because they have 6 years of cash runway, they aren't forced to take the first bad deal that Wall Street slides across the table.
Oh, I see.
That is the key distinction. A zero-revenue developer with only 3 months of cash has to take whatever predatory, highly dilutive financing they are offered.
Because they have no choice.
Right. But Hycroft can sit at the negotiating table from a position of immense strength. A project with a $10 billion NPV and a 30.1% IRR is robust enough to attract non-dilutive financing.
Okay, like what?
We are talking about streaming deals or royalty agreements.
Let's define that for everyone. So instead of selling new shares and diluting everyone, they pre-sell a percentage of the future gold or silver at a discount to a streaming company.
Right.
And in exchange, they get hundreds of millions in upfront cash to actually build the mill.
Correct. They could also pursue debt financing or even joint ventures with senior producers who can shoulder the massive capex in exchange for a piece of the asset.
So they have the time to methodically evaluate partners to find the perfect capital stack.
Exactly.
But it's not just the money. It's the bureaucracy, too.
Oh, the permitting.
Yeah. Transitioning from an oxide heap leach operation to a massive sulfide milling operation means they need a revised plan of operations through the Bureau of Land Management.
Yes, it does.
And that triggers intense federal oversight. They will likely need a lengthy environmental assessment, or worse, a full environmental impact statement, which can literally tie a project up for years in red tape.
The permitting and execution risk is very real. But again, remember the brownfield advantage we talked about.
Right.
It is vastly easier to amend a permit for an existing previously disturbed mine site in Nevada than it is to permit a brand new mine in an untouched ecosystem.
That makes a lot of sense. So we synthesize this into massive, unpriced upside potential, balanced against a multi-billion-dollar funding hurdle and rigorous federal permitting.
Well, that's the landscape. Yeah.
So with everything on the table, what is the final verdict?
Well, based on the structural transformation, the flawless balance sheet, and the underlying asset quality, the final investment rating gives this a bullish score of 8 out of 10.
Okay, 8 out of 10.
Yeah, the final stance is a speculative bullish play. It is an asymmetric opportunity.
But the time horizon is absolutely critical here.
Extremely critical.
This is a multi-year hold.
Yeah.
If you are looking for a quick flip, you are ignoring the timeline of the engineering reports and the reality of mine construction.
Right, you can't rush this.
This requires patience through the Q2 2026 sulfide milling PEA and the early 2027 high-grade PEA. You are waiting for the valuation gap to close as management secures that $2.4 billion financing package.
Exactly. The upside is driven by the sheer scale of the 51-year mine plan, the structural index buying, and the high-grade exploration potential.
Right.
While the primary downside risk remains the execution of that initial capital raise without excessive shareholder dilution.
And as always, we have to remind you that this is an analysis of probabilities and market structures, not financial advice. Every investor must evaluate their own risk tolerance. We are not telling you to buy, sell, or hold this stock.
Absolutely not.
And if you want a cleaner way to read trading charts as you navigate these kinds of momentum shifts, check out VIP Algos through the link below in the description.
Yeah, it's really helpful.
VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas.
Right, but remember, it is still only an educational chart analysis tool.
Exactly. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk.
And again, that is an affiliate link, so we may earn a commission at no extra cost to you. And hey, if this discussion helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
But I'll leave you with this final thought to mull over. If the industry speculation is right, and a senior producer does swoop in for a multi-billion-dollar M&A buyout of Hycroft, well, with one of the largest silver resources in North America suddenly taken off the board and locked up by a major, what does that supply shock do to the valuation of every other silver developer left standing?